You've got $1,000 sitting in your checking account earning nothing. Right now, in 2026, there are real ways to put that money to work. By the end of this video, you'll know exactly which move to make first. I'm going to walk you through 3 strategies, and the third one is the one most financial advisors keep to themselves. But it works better than the first 2 combined. So grab your phone, maybe a coffee, and let's get into it. Let's start with a move that requires zero research. High-yield savings accounts. These aren't the 0.3% savings accounts your parents used. Right now, top online banks are offering annual percentage yields well above 4%. Marcus by Goldman Sachs, Ally, SoFi. They're all competing for your deposits, and that competition is good news for you. Here's the part most people miss. The difference between a traditional bank paying 0.5% and a high-yield account paying 4.5% on $1,000 is roughly $40 per year. That might not sound life-changing, but this isn't about the money you'll earn today. It's about building the habit of putting your money somewhere it actually works for you. And the best part? Your money stays liquid. You can access it whenever you need to without penalties. That's a real edge over certificates of deposit or locked-up investment accounts. Think about Marcus by Goldman Sachs specifically. They launched their online savings account in 2016, and by 2024, they were managing over $150 billion in assets. That's not a startup. That's a trusted institution bringing its infrastructure to everyday investors. All right, that first move is solid, but it's just the beginning. Here's where things get more interesting. Index funds and ETFs. Now, I know that sounds like something your finance professor would mention, but stay with me. An index fund is simply a basket that holds a little bit of everything in the market. You buy one fund and instantly own shares in hundreds of companies across every sector. The S&P 500 tracks the 500 largest U.S. companies. Apple, Microsoft, Amazon, the whole list. A fund that follows this index, like Vanguard's VOO or BlackRock's VTI, historically returns about 10% per year over long periods. 10% doesn't sound like much until you do the math. Invest $1,000 today and leave it there for 20 years. You're looking at roughly $6,700 without adding another cent. That's compound growth doing the heavy lifting. Here's what people overlook. Fees matter more than most beginners realize. Every fund charges an expense ratio, an annual percentage to run the fund. VOO charges 0.03% per year. That's 3 cents per $100 invested. Some funds charge 10 times that amount, and over decades, those fees quietly eat into your returns. Vanguard was founded by John Bogle in 1975. He pioneered the index fund for individual investors, arguing that most actively managed funds underperform the market after fees. 50 years later, his insight holds up. For most people, low-cost index funds beat hand-picked stocks. If this is clicking for you, hit subscribe. I drop videos like this every week, and the best one is coming up next. Okay, remember how I said the third method was different? Here it is. Dividend growth investing. This is the move most beginners never hear about, but it's how a lot of people quietly build serious wealth. Here's how it works. You buy shares of companies that consistently earn profits and return a portion of those profits to shareholders every quarter in the form of dividends. You reinvest those dividends, buy more shares, earn more dividends. The cycle accelerates over time. Not every dividend is worth chasing. Look for companies with a long track record of increasing their dividend payments every single year. That's the key phrase. Dividend growth. Johnson & Johnson has raised its dividend for over 60 consecutive years. Procter & Gamble, over 65. Coca-Cola, over 60. These aren't exciting startups. They're boring, stable businesses that keep raising the check they send you. The strategy becomes even more powerful when you combine it with a dividend reinvestment plan or DRIP. Most brokers offer this automatically now. Your quarterly dividend buys more shares automatically. You don't have to think about it. The growth happens in the background. Here's the data that might surprise you. A 2023 analysis by JP Morgan Asset Management found that dividend-paying stocks outperform non-dividend payers by an average of 2.6% annually over 20-year periods. 2.6% doesn't sound dramatic until you run the numbers. On $1,000 over 20 years, that gap compounds into thousands of dollars of extra growth. Dividend aristocrats, the companies that have raised dividends for at least 25 consecutive years, include names like Coca-Cola, Kimberly-Clark, and Colgate-Palmolive. These aren't speculative bets. They're the kind of companies that keep paying you even during market downturns. That one shift, taking $1,000 and putting it into a dividend growth portfolio instead of a basic savings account, could mean the difference between earning $40 a year and earning $70 or $80 plus long-term appreciation. So let's zoom out. You now know 3 ways to invest $1,000. A high-yield savings account. zero risk, 4+% returns, immediate access to your cash. An S&P 500 index fund, low fees, historical 10% annual returns, compound growth over decades. And dividend growth investing, boring, steady, and quietly one of the most powerful wealth building tools available to everyday investors. Which one is right for you depends on your timeline and your goals. But here's what I will say. If you're keeping that $1,000 in a traditional checking account right now, you're leaving money on the table. One of these moves is better than nothing, and all three are better than staying still. If you found this helpful, share it with someone who needs to hear it. Hit subscribe and stick around. I've got something even better coming next week. And if you want to dig deeper into any of these three strategies, the comments are right below. Let's talk.